Hello, Sector Watchers. Welcome to the show. This is the 123rd episode of Sector Spotlight for Tuesday, the 19th of April. Recording it on Monday, the 18th. Easter Monday, so I hope you all had a great weekend. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you want to share anything with me, provide feedback, please use any of the handles on the screen. For today, last week we did a long-term show. We talked about the sector rotation model and the longer-term outlook. Got quite good feedback on that. Apparently people are triggered by negative headlines when you say something like recession, etc., etc. That apparently is good for viewers, or viewing numbers, I should say. Today we're going to go back to the roots of this show. We're going to talk about sector rotation. We're going to talk about asset class rotation. I want to play around with the large cap, the equal weight, and the small cap rotations. And I want to take a look at the growth and value rotation as it is at the moment. So hopefully we'll have enough time to squeeze all of that in. And therefore, we are going to start right away with a look at last week's asset class rotation. Ladies and gentlemen, this is Sector Spotlight. Let's have a quick look at what happened among asset classes and their rotations last week. On the left-hand side, we have the weekly RRG for asset classes, and on the right-hand side, we have the daily version. Still, both commodity asset classes on the weekly way up inside the leading quadrant, albeit with a loss of relative momentum. So for clarity, I am going to tick those off. So it's DJP and GSG, and refit it so we get a better handle. And then here on the right hand side on the daily, we see that actually if we stick with those commodity ETFs, GSG and DJP, that they are ending or finalizing their rotation from deep inside leading through weakening, lagging, and now DJP is already back inside leading and GSG is close to crossing over into improving. But as you can see on this daily RRG, they have fairly long tails and they're traveling in the right direction. So there's a very good, well, there's not a very good chance. The daily RRG is now once again starting to confirm the strength on the weekly. So we're going to take a look at their charts later on to see if we can find anything in the price chart that helps support further strength in commodities. Another strong asset class is VNQ. On the weekly RRG, you see a nice tail rotating into, oops, wrong chart. A nice tail that hooks back up and is now rotating strongly back into the leading quadrant. And on the daily, you see that the tail is a little bit less strong, it's a little bit ziggy, but it's the highest RS ratio reading on the daily RRG, and it's traveling higher on the RS ratio scale at a stable momentum. So that makes VNQ still an interesting asset class. If we look at the weekly, if we start with the weekly and we bring in the daily, then you can see that those fixed income asset classes, so corporate bonds, government bonds, and high yield are still on a negative rotation. And we had a hiccup over the last few weeks. As you can see here, we had those tails, government bonds, corporate, and high yield rotating back up. And you see that they're inside improving. Corporate bonds already started to roll over. Gov and HYG are losing relative momentum, and it's the question whether they are strong enough to reach leading. It'll be the combination between fixed income and stocks, whether that's going to happen or not. I think that it won't take long before these tails will roll over and rotate back into lagging, and they will be joining the negative rotations as we see it on the weekly RRG. Now that leaves us with stocks and the dollar, I should say. Stocks, clearly a negative rotation on the daily RRG. Here you see that rotation from leading into weakening, and we are now there, and we are continuing lower on the RS ratio scale. Mind you, this is all relative, so it's relative versus VBINX. Doesn't say anything about the price trend of the S&P 500. We'll have a look at that later on, but from a relative point of view, SPY is again starting to deteriorate. The question is whether it will be able to rotate back up, because if you look at SPY on the weekly RRG, you can see that it's a little bit in limbo, it's in doubt. We had that rotation back up, and now last week we see that it's starting to bend back to the left again. It's starting to lose our relative strength. The momentum is as good as flat. It's around 100, that means flat. So this is going to be a tricky but an interesting situation to see who's going to win the battle between stocks and bonds. Looking at the RRG as it is right now, with the weekly still sort of moving higher on the momentum scale, albeit moderate, and with SPY inside weakening, but the tail getting shorter, which means that there is a good chance that it will rotate back up. It looks that the battle between stocks and bonds is won by stocks. But the only reason is because they go down less fast than bonds. That's why they're showing up on the right-hand side. That's where they're beating bonds. It doesn't say anything about the absolute price trend. Finally, the other asset class that we need to look at is the US dollar. And if you look at the US dollar, you see that it is here way up inside the leading quadrant. We had a couple of weeks of lost momentum, but look at what's happening here on the daily. If we highlight the US dollar tail here, you can see that it is back into the leading quadrant at a nice RRG heading, basically underscoring the current strength of the US dollar versus pretty much the rest of the world. Quickly looking at a couple of individual charts. Let's start with the US dollar. Here's the US dollar index, and you can see that it is now comfortably above its rising resistance, which suggests an acceleration, a further acceleration. The rotation back up in terms of relative strength versus VBINX continues. The only thing that's going to stop the US dollar index, or maybe pause or hesitate, is the overhead resistance that you can see around 102, and here is 101 and 102 with a big spike here at 104. Probably better visualized when you look at the euro dollar chart, and you can see that it is starting to challenge the support at 108, euro dollar 108. Once we significantly break below 108 in euro dollar, I think we will see even more deterioration of the euro strength of the US dollar. Go to SPY. Here is the daily chart of SPY, and we already discussed this little sneak peek above its previous high. Makes the trend sideways, not necessarily down, but within that sideways move, the daily chart is now definitely showing lower highs and lower lows. So I think, and we're already, well, sort of below that 440 peak here. Looks as if we're open right now, starting to move below 436.65, which was last week's low. If that happens, then, you know, we got 425.27, but really the 415, 420 area where we had this cluster of lows in the last couple of months, that's going to be the first serious support level that I'll be watching. Here's the weekly version, shows you the same picture with a higher time frame, less clutter, less noise, but the message is pretty much the same. And the risk is coming from the bond market. We talked about that many times, and I keep doing it. We are now very, very rapidly reaching the price target of IAF. So we're reaching that 102, 103 area, which is the target based on that head and shoulders reversal pattern. Relative strength already dipped below its lows, and the result is that yields, 10-year yields, are now rapidly approaching the 3% price target, and they could go even towards that 3.2. We've got rapid rising yields, which is usually not a good thing for the stock market. The only thing that makes stocks better than bonds at the moment is the fact that these bonds are dropping so fast. They're dropping much faster than stocks. That's the only reason why stocks are on the right side. But in price terms, both are going lower, and that's how what you see when you look at the VBINX chart. That is going lower itself. I promised you both commodity charts. If we look at those, I had to make them really, really long. Remember last week when we talked about it? I had to make them really condensed to see whether we had any resistance levels in the past, and we found that area here in 2014. And when you look at GSG, we had those old lows that acted as support and now resistance. The thing is that when we now zoom back to more recent price action, let's set that to 5 and update the chart. Then you see that we had that little break and we're now breaking to new highs. So DJP today is actually breaking to new highs. This is a weekly chart, so this is only today's price action. We were definitely challenging the previous peak, and it looks as if we're going higher. Look at the relative strength here. If we do the same with GSG and make that, zoom that into the most recent price action, update the chart here, then you see that it's not that far. It's not as far as DJP, but you see that we had the break, we tested the old resistance level now as support, and it looks as if we're bouncing. So I think that commodities, DJP and GSG, are now back on track, and we will see more strength for commodities in the weeks to come. Moving to the sectors, we see that last week with a 2.5% loss of the S&P 500, energy came out on top with a gain of 2%. Materials also with a positive return of 70 bips, and then all others were negative with the largest loss for technology at 4.1%. That plotted that on an RRG, we see that staples doing very well. You see the tail here, they were up or down only 40 bips. Let's go over these together. So we got energy, obviously very strong tail, straight through the middle, into the leading quadrant. Materials holding up very well. Industrials picking up, but very low on the RS ratio scale, so remains in negative. Staples strongly inside the leading quadrant, very high relative momentum, one of the highest on RS ratio. Discretionary inside weakening, rotating lower and towards lagging. Utilities still strong, losing a little bit of momentum. Real estate still strong. Financials picking up, but way to the left. Communication services, you can see that it's now already rotating back. It's very close to the benchmark, but turning back towards the lagging quadrant. We got healthcare, had a good week, stable momentum, and then you got technology moving into lagging and getting back in sync with the weekly tail. Now, what I want to do is to actually, because we've seen these pictures pretty much week in, week out. I can almost dream them, and if you're using relative rotation graphs on a regular basis, I'm pretty sure you can dream them as well. Nevertheless, it makes sense to get back to them on a regular basis, because especially the daily RRG's got 5 new observations. This is a 5-week tail, 5-day tail, and that's what changed over a period of 5 days. Sometimes you think nothing has changed, and you look at the RRG and think, hey, it did really change. Because if we plot back, if this it's a nice exercise, if you give a little bit more space and you say 1, 2, 3, 4, 5, this is where we were last week, and now 1, 2, 3, 4, 5, you can see what happened over the last 5 days. What I want to try and do right now is actually take the sectors apart into cyclical, defensive, and sensitive. We've done that before. And then also do it with the large caps, which we're looking at right now, the equal weight, and the small caps, and see how they relate to each other and whether we can find any anomalies or strange things, or maybe they're all confirming each other. So here we have the cyclical sectors. These are the large cap sectors, the series that we usually use. In the middle we've got equal weight, and on the right hand side we've got the small cap sectors. And The big picture is that they're all sort of the same. I think the biggest difference is with small caps. If you look at, let's put them all one by one. So here is consumer discretionary, this is consumer discretionary, and here is consumer discretionary. They're all inside lagging. XLY is picking up relative momentum. That's not happening, not really happening in equal weight, and it's definitely not happening in small cap. So large cap discretionary is picking up recently, but you can see that there is no gain in terms of relative strength, so it remains a strongly underperforming sector. If we go to financials, then we see the same tail. This is a different location. It's got weakening in equal weight. It's already in lagging, and small caps are about to cross over into lagging. In all these universes, it is an underperforming sector that is getting worse. It's losing on both scales. We've got materials, and that's the odd one out in terms of defensives, and we saw that materials was a good sector in the sector rotation model given the fact where we are in the economic cycle. So the interesting thing to see is that the large cap and equal weight are much better than the small caps. And the small caps already started to lose relative strength. Equal weight materials are sort of flat, and in a large cap it's still doing pretty okay actually. So the best place to be if you want to be in materials is in the large cap section. And then we've got real estate, and here it's called roof. And we see something similar. We've got large cap and equal weight nicely moving into the leading quadrant at a strong heading. And you can see that small caps went through a rapid decline, and they're now only picking up. So with regard to the cyclical sectors, I think that in general, they're all confirming each other, which means that discretionary, financials, and are definitely all underperforming, and real estate and materials are the better ones in the cyclical sector. Materials we've seen on the sector rotation model, real estate somewhat similar, and obviously driven or got some support from the rising interest rates. If we take the same approach with the defensive sectors, then this is what we see. So here is the group of defensive sectors: utilities, staples, healthcare. These are the large cap sectors, and you can see that they're all inside the leading quadrant. Healthcare and utilities are doing exceptionally well on a relative basis. Staples went through a correction, a pause in relative terms, but has already started to pick up in terms of RS ratio again. If we look on the equal weight, then we see that healthcare is about to pick up. It's just moved into the leading quadrant. Utilities are way up, in line with what's happening here in the large cap. And you see that consumer staples lost, well, it lost momentum just like it did in the large cap, and it's now starting to pick up, doing the same here. And if you look at the small cap universe, then we see that healthcare is now rapidly improving. It's inside improving and moving towards leading. It's starting to lose a little bit of momentum, but the trend and the trajectory is still good. Utilities had a bit of a break, but is now starting to pick up. And consumer staples is showing that nice clockwise rotation, rotating back towards the leading quadrant. I think the most important message from all these three, because these are all the defensive sectors, and in large cap, in equal weight, and in small cap, these are all predominantly on the right hand side of the graph, which is good, and they're all traveling at a strong RRG heading, which is good, which means that the current market is still driven by defensive stocks, and that is not what you see in a bull market. So defense continues to rule. And if we do the same for the group of sensitive sectors, then we have the large cap version here on the left hand side, and we see communication services inside improving, rolling over. We see industrials going the other way, but still on the left-hand side of the graph. We see technology inside the lagging quadrant. Had a bit of a move up there, but started to move left again. And we've got energy way up in leading, but going through a a period of loss of momentum. And the equal weight and the large cap they're similar. Here's energy, here's communication services, industrials, and technology. They're identical. The differences are when you start to look at small caps, especially when you see energy. Energy and small caps still moving higher on the RS ratio scale at a stable momentum. So the small cap energy stocks didn't go or are not going through the correction, the pause that we see in the large cap and the equal weight. Industrials are picking up. They're picking up a little bit stronger than we see in equal weight and large caps, but they are they are picking up, and technology is sort of following the path that we see in large cap and equal weight. So the big difference here is with energy stocks that are clearly a lot better in the small cap section than they are in large cap and equal weight. And to top this off, I want to go over a few of the individual charts from the large cap section, because that's what we usually look at. But I hope you get an idea of how the interaction between large cap, equal weight, and small cap is at the moment. So back to the weekly RRG of the large cap sectors. I've ticked off energy because we know that it's way up inside the leading quadrant. And then a few of the charts that I think we should keep an eye on. First of all, materials. Continues to do very well, moving nicely into the leading quadrant at a strong heading. The price chart challenging the overhead resistance around 90, 92.5, but look at the relative strength there. That is, there's no doubt that is one of the better sectors at the moment given the relative strength. If you look at energy, here also that relative strength continues very well higher, and in price terms it is just breaking to new highs, which were, previous high was around 80. We're now trading 81.10, 81.12. Moving nicely higher, so that continues to do its job. That's top right here. Technology continues inside the lagging quadrant, losing on the RS ratio scale, and we see why that is here with the relative strength line dropping lower, pulling both RRG lines lower. So this is definitely an underperforming sector for the time being. If we look at staples, that's a different story. We're still trading above the previous high. That's bullish. We are still trading above the previous high in relative strength. That's bullish. And if we look at the tail, we see that we lost some of its momentum. There was a loss of momentum that you saw here, this little dip that's translated into this move here on the weekly RRG. It looks as if we're now already picking up again. And as long as we remain above that previous high in terms of relative strength, staples are expected to continue their outperformance. Here is utilities. We saw the defensive sectors galore. There is no doubt about it that utilities is one of the strongest, if not one of the stronger, if not the strongest sector on the RRG. You see the price charts holding up very well after that breakout. In terms of relative strength as well, so this is no doubt about it that it is one of the leading sectors at the moment. We got healthcare. Let's plot that on the RRG. Medium length tail, stable, nothing special, nicely moving higher. That's exactly what it's doing in terms of relative strength. The only drawback here for the healthcare sector is the fact that we didn't hold up above the previous high. We dropped back into that range. That makes it a risk to drop further, initially to around 134. That's where the previous high was. That's a support level. And it could ultimately go to the area just below 125, what the bottom of the range is. In terms of relative strength, as long as we stay above that range, healthcare remains an outperforming sector. And then finally, consumer discretionary. Heavyweight sector inside the S&P 500, you see that there is a hiccup, a rise of momentum, relative momentum over the last few weeks. That's because it stopped declining, it actually was caught by support in terms of relative strength. That is why that RS momentum line was pulling up. And the big question is whether that's going to pull the RS ratio all the way up. With the test of resistance here and the renewed move lower within this range between 190 and 160 on the bottom, I think that we're now working our way lower towards the bottom of this range, and that will sooner or later have its effect on the relative strength of the consumer discretionary sector versus the S&P 500 and pull it lower, or at least make it move lower on the RS ratio scale again. It remains an underperforming sector. So all in all, defense continues to be strong. Defensive sectors continue to lead. And that wraps up Sector Spotlight for this week. I did not get to talk about the growth value rotation as I announced at the start. So please keep an eye on the RRG blog, because I will write up my views on that current rotation in a blog this week. Anyway, this concludes Sector Spotlight. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again next week at a new episode of Sector Spotlight. Same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.